Confusing times in the markets, folks. We got stocks trading up, down, all over the place, sideways. We got AMD and other tech stocks, AI stocks as well, moving up 4% in a day. Meanwhile, other sectors like retail, SaaS related companies, technology, all moving down. So it's trading all over the place. What the heck is happening right now in the market? Because everyone's worried about this war, peace treaty coming out and thinking that we're going to go on a monumental bullish run after that. Is that really the case? Well, we're going to go over what the market's going to look like over the next 6 to 12 months and the underlying issues that are still very much present despite this treaty being resolved in the near future. So, before we get in, make sure to leave a sub if you guys like the content we're putting out there. Go like the videos, check out the shorts, leave some comments. Let us know anything you guys want to see that's going on in the market right now. All right, so let's get into this with AMD, one of the most prevalent AI stocks moving right now, up 4% today. Check out the 1 year return on AMD, up 330%. Right now, AMD and other AI stocks are benefiting hugely across all sectors. And the AI sector right now in particular is reaping all the benefits as well as some of the major indexes. But if you take a look at some of the other stocks in the market, like let's look at like a Nike, for example, down 67% in the past 5 years. If you invested money in the last 5 years in Nike, you lost money. However, Nike has always been seen as a very safe and well stock in the retail consumer space because they're the leading brand in retail. Everyone you know has some sort of Nike clothing. So you start to question what's happening with Nike, even though if you dive into their numbers, they're actually reporting very well numbers. It's just the money's leaving their stock. So what's going on with them? I mean, they're losing money. However, AMD and other AI stocks right now are gaining so much. And then you look at another major stock in the market like Nvidia. Everyone knows Nvidia, leading market cap in the market with around $5.7 trillion, and they reported earnings on Wednesday, but they're down another 2% today. So that's not great for Nvidia, even though they came out with banger earnings, talked about dividends. They were increasing their dividend from 1 cent to 25 cents. They also mentioned that they were going to aggressively pursue their buyback purchase program again. And their numbers were double beats across the board with revenue, EPS raised both of them. Guidance looks very good and very bullish for the AI space in particular. Now, a lot of people I saw were complaining, why were they down, even though they reported great earnings and are leading market cap in the market. This is because although those were very good, a lot of people were disappointed with the CPU sales that they had, which only came in about $20 million, which accounted for just not much of their revenue. And people saw a bigger opportunity in the CPU space. So they weren't able to capitalize on that just in this quarter. I still think that they will because they've talked about the immense opportunity they have there. However, people just read the headlines and see that it was disappointing for them and they lost out on an opportunity in the short term. So people start to get bearish on it. And people are still worried about this war, which is a huge topic right now. Everyone sees it on the news all the time. You get updates every hour of a new decision that's happening. And it seems like each day it gets better and then worse and then standstill. So we're going to go over why people think this is going to be good for them in the short term, and then we're going to get into the long-term stuff. So this is another headline that came out like it has been every single day. This one was from a few hours ago saying Trump says agreement with Iran has been largely negotiated and Strait of Hormuz will be opened. So basically what's happening. I'm not following this very closely just because it's not something I can control and it's a short-term stipulation that we still have to navigate around with more underlying issues. So just worrying about this isn't going to help me, but essentially they keep getting closer to a deal and then Iran wants to look over and they don't agree with it. And then there's just a lot of stipulation right now surrounding them. And it seems like they can't come to an agreement, but we know that we need to get an agreement to start moving in the right direction. Now, one of the benefits that people are anticipating once this deal happens, whenever it may be, is the WTI crude oil. That's the oil right now has skyrocketed because of this, went all the way up to $95. At the height of it, it got up to about $106 a barrel, which is historically way too expensive. Some levels that we want to be trading at are around $54 per a barrel. That's about normal pricing for gas and oil, but right now it's way too elevated from this war. So resolving this war and conflict will drop these prices significantly. Gas, in turn, will return, hopefully, over the next few months back to normal net levels. So then gas is back to being cheap again and affordable for people because right now it's about 4.60 to $5 a gallon, and that's just way too expensive. Now, people think that after this gets resolved, we're going to emerge into some sort of historic bull run, something where we move super high and just continue to hit all-time highs because indexes are hovering right around all-time highs right now. But I want people to understand that although that sounds like a feasible option, it's really not, given that we have completely elevated yields right now. We have super high inflation, and those are some things that are going to have to get addressed by the Fed chair. And the way you address that is going to completely counteract the effect that the market's going to have. So I'll explain that a little bit more later, but these are some of the yields that we have right now. The 10-year Treasury is sitting at around 4.5%, 4.6%. Now, over the last few days, it's come down from 4.66% to about 4.55%. But these were at all-time high levels around 4 days ago. And the last time the 10 years saw these kind of levels was about a year ago, a little bit longer than a year ago, but still a 52-week high is no joke when it comes to yields. And now if we look at the 30-year treasury, that's giving us at around 5% right now for the 30-year. And if you look a few days ago on the same day that the 10-year topped, the 30-year topped as well at 5.18%, which is the highest that it has been since 2007, which is essentially a 19-year high that it has been at that we crossed just 4 days ago. Now, one thing that we don't want to see with these treasury yields is them to be as high as they are. I mean, essentially, they're an inverse of the market. So money flowing into treasuries or flowing out of markets. That in turn means that we're basically having an inverse effect, and it's going to create a more volatile environment for the stock market in general because of this. It also means that the government has to pay higher yields on their debt. And that means that they're going to have to in turn raise prices, and other mortgage loans and loan givers are going to have to raise their prices to accommodate for the higher yields that the government's paying to pay off their debt, which is what no one wants to see. And it also discourages people from investing. It means people are going to want to put their money in treasuries, although they shouldn't always want to do that. I mean, seeing that you can get 5% return right now on your money over the next 30 years is kind of a no-brainer for most people. They say, "Wow, well, instead of putting my money in a savings account or putting it into a high yield savings account like SoFi used to offer for about 5% a year, I'll just put my money in treasuries, and now I'm going to be making 5% every single year for the next 30 years." And that's very attractive for people. You just put your money in there and not pay attention to it, and you make 5% a year. So people are thinking, wow, why don't I just put my money in there in the meantime? And it's just going to continue to grow and continue to compound over time. So we don't want to see yields going up in terms of the volatility of the stock market. which is why this is not a great thing for the markets in general. We also, like I was saying, have very elevated inflation right now. Now, take a look at this. We got PPI and CPI, which is the producer price index and the consumer price index. Both very much related to inflation. PPI talks kind of deals with more manufacturing stuff like supply chains, retailing, any of those segments. They're raising prices on their end, and the CPI would deal with the finished product that people pay for. So once it hits the market, you're paying more for, let's say, eggs or whatever the commodity may be. Now, those two in turn are inflation. And if you look here, PPI rose to 3% or 6%, sorry, over the last 12 months ending in April, in the most recent report. And CPI rose to 3.8% in April. Now, both of those are the highest we have seen in the last 3 years. And actually, the core PPI is the highest we've seen in 3.5 years. So we are increasing inflation a lot right now, which is not a great sign if you want to be invested in the market. Now, people think that if the war gets resolved, we are just going to have a bullish market. I'm here to tell you that that's just not the case. We might have a short-term move because of news, and people always buy the news. So we definitely will have maybe a 1 to 2 month period, maybe till July, max August, of a bull market, just because the great news, gas is returning to proper levels, and everyone wants to buy the news. So we're going to have a for sure short-term move from this. But if you look in the longer out term, the longer term, like the next 6 to 12 months, this is not a good sign for the market in general because we have elevated inflation and we have elevated yields among several other issues that I'm not even talking about right now. But these are two of the most prevalent ones that we are going to have to deal with. Now, one of the biggest ways that the Fed and the government can deal with this is to have a rate hike cycle. If the Fed comes in and raises rates, that's going to counteract the inflation because you essentially raise rates to make it harder for people to obtain loans. Not many people are buying as much because rates are so high. And that's one of the ways that you can counter inflation. But one stipulation you get from doing this is a very volatile market. And if you have a volatile market, it means you're going to have some sort of short term, if not medium term, correction, or you could see a recession possibly if we start to get bad news, black swan events one after the other, and things don't get better. But for sure, correction if we're going to do this. So it's not going to be great in the short term because of all these issues we have. However, in the very long term, it's going to be okay. But it's one of those scenarios where it's got to get worse before it gets better. And unfortunately, at the point that we are at right now, things are going to have to go this way. It just continues to raise a probability for a rate hike cycle. And that's the proper thing to do right now. If we continue to prolong it, we're going to inevitably end up with a deeper recession the sooner we don't get this corrected, essentially. So, yeah, that's my 2 cents on this. People are very happy with how the market is doing right now. They see all-time highs and they see green days, and that the peace treaty might be settled soon. But that's just very short-term, fix and remedy. That's not what it's going to do in the long term. We're going to have bigger implications because of the underlying issues right now with like inflation and yields being too elevated. Now, we also have AAII investor sentiment that just came in about a few days ago on the 20th. This tells us how bullish, neutral, and bearish people are on the market. And we just came in at 43% bearish, which it's both good and bad. It's good because typically you want to see that everyone is bearish because the market typically does the opposite of what most people do. You see, when most people are very bullish, the market just becomes bearish. An example of that is last year, right before the April lows from the Liberation Days. Everyone was super bullish out in February. We actually saw the highest margin calls, and every single person was buying margin and everyone was buying in, and we were essentially fear greed index of 90s. Every single person just wanted to continue to buy, and that's when things started to flip and went negative. And then once everyone started to get bearish, and we saw in April and late March that the bearish sentiment right here, that's at 43%, was actually in the 60s, and we hadn't seen those levels since coronavirus in 2022 and 21, as well as the great financial crisis back in '07 through '09. So once we saw those levels, we knew that you essentially do the opposite of what the sentiment's looking like. So that's why it's good right now being at 43% bearish, because you like to see that more people are bearish, but you also like to see that once you have a good market, like if things in the market look okay, then it's like, okay, well, this is a great time period right now to be buying because everyone's bearish, but we don't really have any underlying issues. But right now, we actually do have issues. So this comes in as kind of okay news because people are bearish and they have a rightfully so a reason to be because of all the things I've been talking about right now and where I think that the market's going to be heading over the next 6 to 12 months. So what I would recommend for you guys to do is, if you haven't already, go to our website, for Gamma. Link's going to be on our page down here, and go run some projections on your own numbers. Go check some companies out. But what I recommend doing is essentially having a long-term outlook. A lot of people want to be very bearish or bullish in the short term. However, short-term news is almost always volatile, and the president or anyone could come out and say something good or bad, and the market reacts that way. That's not how you want to be playing this game, because that would just essentially be swing trading on news, and you're not going to squeeze a lot of money out from doing that, because one day you could be up 5%, the next day you're down 6%. So it's too much worrying for the average person, and I wouldn't recommend it even if you could withstand that. I would say, if you're a normal person, continue to run your own numbers, go over any company that you feel is a great buying opportunity and undervalued right now, and put money in that and just let it sit. That's it. All you gotta do is rerun the numbers every time they come in with earnings and listen to conference calls, and just make sure that the company hasn't done anything for the worst for their company. So make sure that everything is going the way that you expect, and that's all you got to do. And then your money is going to appreciate like crazy if you have a strong company that is able to withstand the recessions or any of the bearish markets. So that's all you got to do. Also, hold some money, some cash on the side right now, just because I feel like over the next several months, we're going to have a lot of great opportunities to deploy that cash. And you're going to see even bigger discounts right now in certain sectors once that time comes. And once again, once we leave this next bear market, all the money is not necessarily going to funnel back into the AI sector. Money rotates, and the number one sector right now that's primed to have money rotate into them is the SaaS related companies, the software used for a service. So stocks like Zeta, if you've ever checked them out, very good, great SaaS related companies, ServiceNow, stuff like those companies are the ones that are going to benefit. But most companies, as long as they have a strong balance sheet, income statement, are going to benefit in the long term. So continue to run your numbers and continue to find great deals out there in the market. So if you guys enjoyed the video today, go leave a sub, like I said earlier, and leave some comments. Let us know anything that you want to know about, and we will discuss those topics in a future video. All right, guys, have a great day.